Normally when you think about gold miners, you think about Barrick Gold. And since the stock is back to the levels of 1992, and it has also not moved anywhere since 2013, maybe this is a good time to look at it. First of all, they don't only produce gold. They also have mines that produce copper. They're also investing in silver mines now via Hercules Silver. It is very tiny, but just so you know, it is not a pure gold play. They are positioned on many different continents: North America, South America, Africa, Asia. The South American and African mines are riskier. South America especially because often when new governments come to power in South America, they often raise tax, especially on commodity businesses. In Africa, of course, there's a huge geopolitical risk. I mean, let's say they have a mine in Mali here. Let me just phrase like this: Mali's not the most stable country. So is Senegal, Ivory Coast. There is a risk with these mines. One good thing for them is though, their proven reserves are growing, so they will not have to buy new mines, which is pretty expensive. They expect their production to grow. They will probably able to do this. They have a track record of increasing production, and with them extending their reserves, I think this is not going to be an issue for them. Now, when it comes to these miners, two things are important: the price of a commodity and the cost at which they can extract it. Their margins are influenced by gold prices. It is not only dictated by the gold prices. If we look at the gold prices from 2013 to now, we can see around 2013 to 2020 there was a low, and otherwise it was very high. But here we can see the margins are not determined by it. During 2016, which was a low year for gold, they was fairly high. 2021 was a high year for gold, it was a bit higher. And even with gold prices still being on the high side, free cash flow margins are down. We can see you need to look at the extraction price. And the CEO said mining costs are starting to drop. And with their metrics coming down, we're probably gonna have some better margins for now, unless gold prices change. But that can very easily reverse. And this also leads to highly unpredictable free cash flow, which has spikes and downs. And this is also why the dividend is very irregular in these types of businesses. If a commodity business, which is very cyclical, has a very steady dividend, either they're not paying out as much, or they're taking on debt to pay this. One example would be Shell, which has had a very steady dividend policy, but had to take on a lot of debt from time to time. Here, like Barrick a bit more, they have deleveraged and they're basically net debt free. That means they can also return more free cash flow to the shareholders, so overall a very conservative company in that sense. But one without much growth. Yes, their revenue growth is partially dictated by gold prices, but increases in production should lead to overall growing revenue. And in 2019, they had a big merger with Randgold, so overall no revenue growth since 2013 is kind of disappointing. Gold prices have even moved a bit up since 2013, so you would expect them to have increasing revenue over the time. And in fact, on a per share basis since 2013, revenue has declined a lot, because they financed the acquisition with new shares. So overall, on a per share basis, if you have invested in the company for long term, you are down a lot. So when we now have a commodity business which is not growing, we should determine what the average free cash flow is. And we can see on the downside it's around 1.2 billion, on the medium side it's around 1.5 billion, and on the high side it is around 3.6 billion. Let's be fair, let's call it 1.5 billion cycle adjusted. So if we look that they have 1.5 billion in free cash flow, and they have a 27 market cap, that is around an 18 multiple. And for a cyclical commodity business, an 18 multiple is pretty high. Especially if it hasn't grown since 2013, and on a per share basis steadily declined since 2013. But let's say the mines are going to continue to expand, which we have seen, gold prices continue to slightly go up over time, they're gonna go back into growth mode. Currently on a free cash flow per share basis, they're around 88 cents, but let's do it at 90, just to give them the benefit of a doubt. 4% growth rate for the next 10 years, that includes a slight growth in the gold value, and just some expansion of production. 10% discount rate, 14 multiple. It is a cyclical commodity business, and those ones will always trade at a lower multiple. 40% free cash flow payout ratio with a little deduction due to taxes. If we believe these assumptions, we would pay 9.33. The shares are currently trading at 15.71. I don't think these assumptions are very conservative. I think they might be a bit too high even in my opinion. I just do not like it when the company declines since 2013 on a revenue per share basis, especially when it's a cyclical commodity business. I wonder if we believe maybe those assumptions are too conservative. They're back in total growth mode, gold prices are gonna go higher, 8% growth rate for the next 5 years, 6% after that, 20 multiple, well then yeah, 15.73, that is basically the exact value right now. For me, those assumptions are way too aggressive. What if it's gonna develop like it is right now? Decline in growth over time, at least on a per share basis, 10 multiple. well then we would only pay $5 per share. While I think this is a bit too conservative, I think they're back partially into growth mode. This would be a bit more realistic assumption for me, 3% growth rate and 2% after that. We would still be at $8.37 per share though. It is just not a business I'm keen on having. This one is just currently very highly valued and does not have a good track record of actually producing value. Yes, they paid out a dividend over time, but it was nothing massive, and at the same time they diluted you a lot without actually improving free cash flow. Well, yes, they have deleveraged a lot since 2015, so they will probably be able to pay out all of their free cash flow if they want to, but the valuation is just not in my favor here. This is a stock that I would like to buy when it is in a crisis like 2015, but right now it is just not in my value range. I will put it on my watch list. What do you think about it? Do you own any gold miners or any miners in general? Write it down below. Have a good day.